Asset classification. In all the questions we've seen so far, it just tells you what the asset is classified as. But now we're really going to get into classifying those assets ourselves. That could obviously complicate a question if you not only have to deal with everything we've seen so far, but it doesn't just straight up tell you what type of asset it is. Is it a capital asset? Is it some other type? We'll see what this entails. Asset classification is important for accounting, taxation, and financial planning purposes. I mean, for our purposes, taxation mostly, but let's say you are doing a sim and the prompt of the sim is someone's trying to do some financial planning with their taxes. Yeah, you can see that as well for sure. Assets can be classified into various categories, such as capital assets, non-capital assets, and like-kind exchange properties. We've got a whole dedicated item here on taxable and non-taxable dispositions. We got an overview of a few of these. Capital assets, these generally include real and personal property held by a taxpayer, which are not used in their trade or business. These assets are typically held for personal use or investment purposes. Examples here would be real and personal property held by the taxpayer, such as a primary residence, personal vehicles, and personal belongings. We've also got copyrights, literary, musical, or artistic compositions that have been purchased by a taxpayer. In this case, the taxpayer is not the original creator of the work. Keep in mind there, because we're going to see what if you are the original creator of the work, that's going to be classified differently. And then stocks, securities, partnership interests, investment assets, and corporate goodwill. These are all other examples of capital assets. And classification, the name of the game for a lot of different topics throughout the exam, so make sure you're familiar with this. When capital assets are sold, any gain or loss is considered a capital gain or loss, which may be subject to different rates depending on the holding period, short-term, long-term. So we see you want to be a capital asset. That's a pretty good classification. You get better tax treatment with those. Couple more points about capital assets. Capital assets are all property held by a taxpayer except some of these items here. Inventory held for sale to customers in the ordinary course of business. That's inventory. We'll talk about that more later as well. Accounts or notes receivable from sales or services from the taxpayer's business. Depreciable property and real estate used in the taxpayer's business. Got treasury stock. And then also any copyrights, artistic, musical, or literary compositions held by the original artist. And when these are sold from the original creator to another party, this is taxed as a capital gain to the creator. Why is this important? I mean, like I said already, why this is important, we have to first identify what type of asset this is. But also you can see a sim where you have to list out all of the capital assets, all of the non-capital assets. So something like this could be helpful for you. Got an example here. Morgan qualified as head of household for year 10. Morgan's year 10 taxable income was $120,000 exclusive of capital gains and losses. Morgan had a net long-term loss of $7,000 in year 10. What amount of this capital loss can Morgan offset against year 10 ordinary income? Well, the capital loss deduction is limited to $3,000 per year, with the excess carried forward indefinitely. In this case, Morgan can deduct $3,000 and carry forward the remaining $4,000. Always checking in, got examples, just going to pop them randomly throughout the course, randomly throughout the lesson. Make sure keeping you on your toes. All right, now we got non-capital assets. Non-capital assets are those assets that are used in a taxpayer's trade or business or held for sale to customers, such as inventory. Examples of non-capital assets include inventory, so anything that the business holds for sale to customers in the ordinary course of business. Depreciable property used in trade or business, assets that lose value over time, such as machinery, equipment, and buildings. These fall into these categories, and if you know these, you know that there's something special. There's definitely a lot of tricks and items here. These are very difficult. These are classifications of types of assets. Is the asset a 1245 asset? Is it a 1231 asset? So that's going to be incredibly, I'll say difficult. Is it the most important thing on the exam? It's not, but it's incredibly difficult. I would make sure you're mastering partnerships and S corps before you get to really drilling this down. But this will be tricky, and throughout the years, I've got a lot of better ways to talk about these and describe what they are. But there will be a lot of memorization to be had if you want to get these right. And these categories can either be capital or ordinary. Copyrights, literary, musical, or artistic compositions that are held by the original artist or creator. In this case, the creator is using their work as a part of their trade or business. And just classification, memorization, nothing too mind-numbing. It just takes time to memorize these points. Gains or losses from the sale of non-capital assets are usually considered ordinary income or losses, which are subject to regular income tax rates. So we're starting to see, we have been seeing all the implications of these different classifications because they result in different tax methods. Like kind exchanges, here we go. Now, as I said, we've got a lot of this in our lesson on taxable and non-taxable dispositions. However, it's important. We'll talk about it here. It also is relevant. A like kind exchange, also known as a 1031 exchange, this is a tax deferred transaction that allows a taxpayer to exchange certain types of real property used in a trade or business or held for investment. The exchanged properties must be of like kind, meaning they're similar in nature or character, even if they differ in greater quality. So, a old truck for a new truck, a piece of land for another piece of land, let's say a warehouse for an office building, those are relatively in the same category. When a taxpayer participates in a like kind exchange, they can defer recognizing the gain on the sale of the given up property by reinvesting the proceeds into another like kind property. This then allows the taxpayer to defer paying taxes on the gain until the replacement property is eventually sold in a taxable transaction. Now, this is here for the IRS to help facilitate business, right? Got to stimulate the American economy. So, if I have an ice cream truck and someone else has a delivery truck and we exchange those because I don't need an ice cream truck right now, I need a delivery truck, and the other party needs an ice cream truck, this is to helping to facilitate the transaction, thus allowing business to flow in the good old American economy. That's why this exists, if you were curious, and I think that helps to understand kind of the intricacies of all of this. But again, I can't. There's a lot of rules with it, meaning I can't trade an ice cream truck for a piece of land that's not similar to like kind property. So we'll see examples of that. Again, definitely tackled very heavily in our other lesson on taxable and non-taxable dispositions. All right, asset classification. So we're doing. I'm going to have a lot of repetition with this. First off, there's going to be 2 slides on this for repetition. This is going to be something just a lot of memorization. There are a lot of items such as the previous example where I like to give sort of insight into it. I like to describe it, but this is just something I would just memorize. That's my personal recommendation, my approach. All of these criteria just memorize that a 1231 is used real or personal property used in a trade or business held for more than 12 months, right? Just memorizing these points. And we will have charts and graphics and memorization guide to help with all of this. But again, I'm not going to really go through the why here, more so just memorize these dang points. All right, so first off, we've got capital assets. These are generally property held by taxpayers that are not related to their trade or business. Examples of capital assets include stocks, bonds, and personal use property, such as a taxpayer's home or car. Gains and losses on the sale or exchange of capital assets are subject to capital gains tax rates, with preferential rates for long-term capital gains, which are assets held for more than 12 months. Short-term capital gains, assets held for 12 months or less, are taxed at ordinary income rates. Now this, we've seen this before. This is everything we've seen up until now. Then we're going to introduce all these sections, the section 1231. And yes, these definitely memorize the names, memorize the numbers. That's going to be important. Section 1231, let's start off with this. This pertains to the tax treatment of gains and losses. So depreciable personal property, real property, those are the attributes. Because again, a question could say, what type of classification is this? Is this a capital asset? Is it a 1231 asset? And it'll give you a description. It's a piece of land someone's holding. They're using it for their business. They're raising crops on it, something like that. So understanding these points, memorizing them, absolutely essential. Depreciable property, real property used in a trade or business, held for more than 12 months. So if it doesn't meet these criteria, it's not 1231. It does not apply to personal use property. Section 1231 losses are treated as ordinary losses, while Section 1231 gains receive capital gain treatment. Again, I know this is a lot, and if I wrote the exam, I wouldn't be having you memorize this stuff, but unfortunately, I did not write the exam. I'm not the one actually testing you. So just memorizing things such as this as well, that the losses are treated as ordinary, whereas the gains receive capital gain treatment. Corporations can offset capital losses and then be taxed at a 21% rate. Individuals receive preferential tax rates on capital gains, as we saw. If there is a net Section 1231 gain, taxpayers must look back 5 years and recapture any previously recognized Section 1231 losses. And as the times come where we really need to go through that, depreciation recapture, we will go through, we'll see examples of it. Just a general, as we see it here, general idea of what depreciation recapture is. You use depreciation as a deduction to pay less tax, right? That's pretty great reason for depreciation. However, if you take, let's say, excess depreciation, bonus depreciation, Section 179 depreciation, any of these things that we'll see in our depreciation recapture cost recovery lesson, then you sell it, Well, you got the full depreciation for the asset, but didn't hold it for its whole life. So the IRS is going to they're going to recapture some of that and make you pay tax on those deductions that you had originally taken. That's the broad general idea of depreciation recapture. Next up, section 1245. This applies to gains only. So if you see a loss in a transaction, it can't be a 1245. So again, these are all the criteria you need to memorize, specifically those involving machinery, equipment, and depreciable personal property used in a trade or business for more than 12 months. The amount of the section 1245 gain, taxed as ordinary income, is going to be the lesser of the gain recognized or the accumulated depreciation taken. Any excess gain is treated as a section 1231 gain. So just lots of rules. Think about it like a logic tree. All of these criteria are going to help you identify what sort of asset we should classify it as. To round us out, we've got section 1250. This is the last of these sections. Section 1250 addresses the tax treatment of gains on depreciable real property, excluding land. So you see, just again, like you can see something, we've got a sale on land and it's a gain. Well, just because it's land, it's not going to be 1250. So we have to go through the other ones and identify what it might be. Used in a trade or business for more than 12 months. Again, if something's less than 12 months, we see that 12-month criteria for both 1250 and 1231. So yeah, just a lot of different criteria that you need to memorize. Again, it's like a decision tree. You got to run through. Does it check this box off? Okay, cool. Does it check off all the boxes? It may be a 1250. For C corporations, section 291 applies, treating 20% of the lesser of the recognized gain or accumulated straight line depreciation taken as ordinary income, while the remaining gain is treated as a section 1231 gain, subject to capital gains tax rates. This provision aims to recapture some tax benefits received through depreciation deductions and balance them with tax consequences upon disposition. So also, let's think about this. This is all sales, right? Gains or losses on selling these assets. Depreciation, in theory, you hold the asset until its useful life is up and you fully depreciated it. Cool. But if you sell it prematurely and don't use it all up, that's what we're talking about here. And then the whole concept of depreciation recapture. For individuals, Section 1250 gains are characterized as Section 1231 gains, netted against 1231 losses, and subject to that 5-year look-back rule. Any unrecaptured gain is taxed at the maximum rate of 25%, with the amount of the gain being the lesser of the recognized gain on the Section 1250 asset or the accumulated depreciation taken on the asset. I know, so that was a lot. These last two slides were just, that was a lot. That was intense for sure. A couple points on this overall. Is this the most important thing on the exam? No, it's not. So again, I highlight the most important things to know. This is something, however, that does come up. I'm not saying it doesn't come up. So I would just take this with a grain of salt. If you're a day out from the exam, you should be a lot more prepared by that point. But if you're a day out, I wouldn't try to cram this in. Take this and try to memorize the rules a little bit each day, and then obviously practice questions. We'll have a lot of questions on this as well for you to practice. So keep that in mind, but take it day by day. This is why you got to get through all the material and then maybe go through the material again. You have time for review, all that good stuff. Now, in summary here, all of these sections outline the tax treatment of gains and losses on various types of property used in a trade or business. These sections distinguish between different types of property, holding periods, and taxpayer entities, resulting in different tax consequences depending on these specific circumstances. And oh boy, are there a lot of circumstances that we've seen here. Now, some things are not going to come up as much, really. I'll just say it. A lot of times it's going to just be corporations or just individuals. They're not going to drill you on every single point to memorize here, but you'll get an understanding of that when you practice the questions. Do some sims, do some multiple choice. All right, as if you thought I wouldn't have examples for you to actually show you how all the crazy rules work. So we've got the following assets: stocks worth $20,000, and I'm just going to do 1 for 1, 2 for 2. So stocks, we know that's a capital asset. Stocks are capital assets. They're held for investment purposes. I don't know what else they'd be held for. Maybe some flexing purposes. Oh, I have a bunch of Tesla stock. And not used in John's trade or business. In this case, the stocks worth $20,000 are capital assets. I know there was a point, I don't think companies do this as much anymore, but let's say you owned a bunch of Carnival Cruise Line stock. If you were a large enough shareholder, you would be able to go have the special shareholder party if you went on a cruise, or with Disney, that was the case as well. I don't think that's the case anymore. Things are not as fun as they used to be. Not that I ever would have had enough stock to warrant any of that. I'm sure it's quite a bit. Moving on, next, we've got a warehouse used for business purposes, purchased for $150 with a current fair market value of $180. Now we're going to see that this is a Section 1231 asset. Now this is not going through all of the criteria that we've been seeing. The warehouse used for business purposes is a 1231 asset, as it is depreciable real property used in a trade or business and presumably held for more than 1 year. I know it doesn't have all the details here, but also, again, it would have to be held for more than 1 year. In this case, the warehouse with a current fair market value of $180,000 would most properly be a 1231 asset. Next up, we have a machine used in business purchased for $50 with a fair market value of $35 and accumulated depreciation of $10. This we're going to see is a 1245 asset. And why is that? Well, it's depreciable personal property used in a trade or business and subject to depreciation recapture. In this case, the machine with a current fair market value of $35 and accumulated depreciation of $10,000 is a Section 1245 asset. And then lastly here, we see our 1250. We've got residential rental property purchased for $200,000 with a current fair market value of $250 and accumulated depreciation of $30. The residential real property is going to be a Section 1250 asset, as it is depreciable real property not used in a trade or business and subject to depreciation recapture on unrecaptured Section 1250 gain. In this case, the rental property with a current fair market value of $250 and accumulated depreciation of $30 will actually be a 1250 asset. I know this is one of the most simple examples based on what we just saw. We'll be going through this more. As I said, I'll have multiple slides on this. We'll run through it as much as possible. But practice, memorize, you'll get it. All right, like I said before, I was going to have another slide on it. Here it is. We're just going through it again. If you feel like you're good at this point, you can skip this slide. This is just going through it again. There may be one or two extra points that we didn't talk about, but here we go. These are all different categories of assets classified by the IRS based on their useful life and how they are taxed when sold or disposed of. 1231 assets, these are generally business or investment assets, such as equipment, vehicles, real estate, and intangible assets like patents or copyrights. These assets are held for more than 1 year and used in the production of income. If the sale of a 1231 asset results in a net gain, the gain is taxed as a long-term capital gain, which has a lower tax rate than ordinary income. However, if the sale does result in a net loss, the loss is treated as an ordinary loss, which can be used to offset other types of income, such as salary or business income, which are both ordinary income. Next up are 1245 assets. These are tangible assets. So again, we're repetition. We're seeing these over and over. Tangible assets subject to depreciation, such as machinery, equipment, furniture, and fixtures. These assets are held for more than 1 year and are used in the production of income. If the sale of a 1245 asset results in a net gain, the gain is taxed as ordinary income, not as a long-term capital gain. This is because the depreciation that was claimed on the asset during its useful life is recaptured, and that is taxed as ordinary income. And that makes sense because depreciation is an expense that would normally have reduced your ordinary income. So if you're recapturing it, you're taxing it as ordinary income. However, if the sale results in a net loss, the loss is treated as an ordinary loss, which can be used to offset other types of income. Next up, 1250 assets. These are similar to 1231 assets, but they are specifically defined as real property that's used in a trade or business, such as buildings, land, and improvements. So real property, real estate. If the sale of a 1250 asset results in a net gain, the gain is taxed as a long-term capital gain, which has a lower tax rate than ordinary income. However, if the sale results in a net loss, the loss is treated as an ordinary loss, which can be used to offset other types of income. All right, that was a nice run through of just seeing all the criteria here. In summary, the main differences between these assets relate to the type of the asset, the length of time it's held, and how gains and losses from the sale of these assets are taxed. 1231 assets are generally business or investment assets held for more than 1 year and are taxed as either long-term capital gains or ordinary losses. 1245 assets, these are tangible assets subject to depreciation and are taxed as ordinary income if sold at a gain. And 1250 assets are real property used in a trade or business and are taxed as long-term capital gains or ordinary losses. Perfect. We're running through, getting our practice in. It's a lot, but you can do it. You can handle it. This is a marathon, not a sprint. It is an exam of attrition. They try to weed people out here, and you are not going to get weeded out. You are going to stand firm. Keep practicing. We're powering through. Depreciation recapture, I mentioned a little bit about what it was before, but let's actually have a dedicated slide about it. This is a tax concept that applies when a depreciable asset, such as real estate or business equipment, is sold for a price that exceeds its adjusted tax basis, which we know the adjusted basis is the cost minus accumulated depreciation, plus maybe any additions or improvements. The purpose of depreciation recapture is to tax the portion of the gain attributable to depreciation deductions that were taken over the life of the asset, as these deductions reduce the taxpayer's taxable income in previous years. Again, that's the point. It was a benefit for you in the past, and you're benefiting from it because you are now selling that asset at a higher price. The point of depreciation recapture is to recapture and tax the accumulated depreciation at a specific rate. It worked to accomplish the goal of ensuring that taxpayers cannot benefit from both depreciation deductions and tax-free gains on the sale of an asset. Depreciation recapture typically occurs for tax purposes when a taxpayer sells a depreciable asset that has been used in a trade or business or held for the production of income. The most common scenarios involve the sale of rental properties or business equipment. Nothing crazy, nothing too wild, just getting your knowledge up. Moving on to an example here, we are dealing with income gain and recapture classification. On March 3rd, year 6, Johnson purchases and places into service 5 years Maker's tangible property costing $150,000. On November 30th, year 10, Johnson sells the property for $160,000 after having taken $115,200 in Maker's depreciation deductions. Now, the IRS probably not too happy about that, because the person took some deductions, even though they eventually ended up selling this. What amount of gain should Johnson recapture as ordinary income? Well, knowing our classifications, we can see that this is Section 1245 property, and as such, would be subject to 1245 recapture. Now, Section 1245 property includes all depreciable personal property, for example, equipment and machinery, which we see here. Under Section 1245 recapture, gains are treated as ordinary income to the extent of depreciation or amortization taken on the property. The basis here at the time of sale, we've got $34,800 minus the $150,000 purchase price, less the $115,200 in depreciation. Hence, due to the Section 1245 recapture, the amount of depreciation allowed, the full $115,200, will be considered ordinary income, and only the remaining $10,000 will be considered capital gain. Next up, we have a taxpayer selling $300,000 worth of equipment that had an adjusted basis of $250,000. Through the date of sale, the taxpayer had deducted $60,000 of depreciation. Of this amount, $25,000 was in excess of straight-line depreciation. What amount of gain would be recaptured under Section 1245? Now, under 1245, the amount of depreciation in excess of straight-line depreciation is irrelevant. The excess depreciation rule is a Section 1250 rule and applies to real property. So a nice trick there. In this question, $60,000 of depreciation was deducted, and at first glance, the answer would appear to be $60,000. However, 1245 actually only requires that the lesser of the depreciation taken, so $60,000, or the gain recognized, which in this case would be $50,000, be recaptured. Now, this gain would be the gain realized and recognized. It's just the same thing here. We know the difference between realized and recognized. In this case, would be $50,000. Next up, 3 years ago, a self-employed taxpayer purchased office equipment for $40,000. During the current tax year, the taxpayer sold the equipment for $48,000. At the time of the sale, the taxpayer's depreciation deductions totaled $26,000. What part of the gain may be taxed as long-term capital gain? Great question. I'm glad you asked. Well, when the property is sold, the realized gain is the difference between the proceeds and the adjusted basis. In this question, the difference between the $48,000 and the $14,000. So we've got $40,000 minus $26,000, or $34,000. Under Section 1245, office equipment qualifies as Section 1245 property because it's not real property. The total depreciation deducted will be recaptured as ordinary income, and the remainder, any amount in excess of the original cost, is going to be Section 1231, which is taxed as a long-term capital gain. In this question, the $26,000 of depreciation deductions is ordinary income, and $8,000 we get from the 48 minus the 40 is Section 1231, taxed as long-term capital gain. Now, do note here that Section 1245 actually does require the lesser of the depreciation taken or the gain recognized, as we saw, repetition through these rules, to be recaptured. Normally, the two steps of the formula produce the same result. All right, building on those examples, knocking them out. Next up, a taxpayer purchased a delivery van for use in the taxpayer's business for $35,000 on February 1st of the current year. The taxpayer then sold the delivery van for $38,000 on July 15th of the current year. Good for him. Automobiles generally do not go up in value, but that sounds good. What is the taxpayer's Section 1231 gain as a result of the sale? Well, why is it going to be zero? The gain on the sale of the delivery van is not a 1231 gain. The delivery van is an asset used in the taxpayer's trade or business, but it was not held for more than 12 months, so it's not a Section 1231 asset. Lots of tricks, lots of points to keep in mind we see as we're running through these questions here. Lots of ways to get tripped up on the exam, but you're going to get enough practice so that does not happen. We're going to see an example on depreciation recapture. Let's say a taxpayer purchases a rental property for $200,000, of which $150,000 is allocated to the building and $50,000 is allocated to the land. Now, land is not depreciable. We should know that for sure, but the building is. Now, the taxpayer takes annual depreciation deductions for the building over the years, totaling $50,000. The adjusted tax basis of the building at the time of the sale, well, that's just going to be $100,000. That comes from the original cost minus the accumulated depreciation. Nothing too wild so far. Then the taxpayer sells the rental property for $250,000. The sale price allocated to the building is going to be $187,500. Okay, and this is something we may need to see in various questions where we need to see the percentage of something. So you may see some questions that say the property tax assessment of something determined that 75% of the value was allocated to the building, 25 to the land. So that is just something, again, understanding the allocation between, let's say, one purchase price. In this case, 150 was allocated to the building, 50 is allocated to the land. So in this case, 75%. The total gain on the sale of the building is going to be $87,500. So the $187,500 sales price minus the $100,000 adjusted tax basis. Of the $87,500 gain, $50,000 is subject to depreciation recapture as it represents the accumulated depreciation previously taken. This portion of the gain is taxed at the applicable depreciation recapture rate, for example, 25% for real property under Section 1250. The remaining $37,500 gain may be taxed at the applicable long-term capital gains rate, provided the property was held for more than 1. Now we're moving on to Section 1250, recapture for individuals. This is a provision in the US IRC that requires taxpayers to recapture a portion of the depreciation taken on certain real property as ordinary income when the property is sold or otherwise disposed of. Obviously, we're kind of touching upon topics that we've seen before. This is specific for 1250, whereas we saw this for the other sections before. This provision specifically applies to real property subject to depreciation, such as residential rental properties, commercial properties, or other depreciable real estate. Now, when a taxpayer sells a depreciable real property, they need to determine the amount of depreciation recapture, which is the difference between the actual depreciation taken and the allowable straight line depreciation. The recaptured amount is then taxed at the ordinary income tax rates up to your maximum rate of 25%. The remaining gain, if there is any, is then treated as long-term capital gain and is subject to preferential tax rates. How does this work? Let's see an example. All right, well, John bought a rental property for $300,000, and over the years, he's claimed $100,000 in depreciation deductions. John then sells the property for $400,000. All right, what is the adjusted basis of the property? Well, that's pretty straightforward. He bought it for $300,000, had $100,000 of depreciation, so that is $200,000. Next, what's the gain on the sale of the property? Well, that's just going to be your sale price. What did you get versus what did you give up? The value received minus the value given up. So that's 400 minus 200 gets you 200. Awesome. Then we examine the depreciation taken over the years. Now, in this case, John has claimed a total of 100 in depreciation deductions. This entire amount is potentially subject to recapture under 1250, even if it matches the allowable straight line depreciation. There's no excess depreciation in this scenario, as we've seen in other scenarios there has been. So John has to recapture this $100,000 as ordinary income because, again, what the whole point of this is that he used it as a deduction, but he didn't use the property to its full life, subject to a maximum tax rate of 25% for real estate here. This is often referred to as unrecaptured Section 1250 gain. The remaining gain of $100,000, which comes from our total gain minus the 100 recaptured depreciation, that's a long-term capital gain, assuming John held the property for more than 1 year. And then it'd be short-term if it wasn't. In summary, this 1250 recapture requires individuals to recapture the entire depreciation taken on certain real property as ordinary income when the property is sold or otherwise disposed of. The recapture provision ensures that taxpayers do not unduly benefit from depreciation deductions that defer tax liability on real property investments. God forbid the taxpayers get a benefit. Am I right? All right, moving along. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.